Welcome to the Honolulu Hawaii monthly real estate and economic report. I'm Patrick ONeill, principal broker owner at Luxury Homes International, and with us today, the president of TZ Economics and one of Hawaii's leading economists, Mr. Paul Brewbaker. Aloha, Paul.
How's it, Patrick?
Love the Rainbow Warrior hat.
Go Bows.
Okay, go Bows. All right.
Haircut.
Go haircut. All right. So we have some interesting housing statistics to look at. The monthly report just came out from the Honolulu Board of Realtors. And before we do that, I wanted to ask you a little bit about the unemployment situation.
Sure.
And we had touched about this last time. Last month, the enhanced unemployment benefits ended for tens of thousands across the state of Hawaii. And yes,
that's been happening across the country over the
across
mainland.
the country, right?
Across the mainland over the summer, yeah.
And there were sort of two predictions here. One looking at the Yale study, suggesting there's no correlation between the enhanced unemployment benefits and actual employment, and others said maybe that's correlation, causality, who knows. And the other school was, as soon as we get through this and these enhancement benefits are gone, we would see all these employees come back, in particular the hourly employees. What has actually happened?
We need to be careful about this, because that latter prediction was always bogus. So there was what economic theory said, which is that the unemployment benefits are not really the factor that's preventing from people going back to work. And then there was this I call it the Chamber of Commerce view, which is like, I didn't take enough economics to know that it's much more nuanced than this. And therefore, my simple prediction is people aren't working because they're making too much money on unemployment, which, if you say it that way, it just sounds bogus, but it always was. And as we're finding out, well, as some people are finding out, because most people knew that it was bogus, it's not really moved the dial. It's not moved the needle to have withdrawn the enhanced unemployment insurance benefits that were made available.
We don't see a return of employees after
we don't say
that
any
ended.
We don't say any material difference with or without the enhanced unemployment insurance benefits. And that's what economic theory actually told us. There's something deeper going on here. Yeah.
So everywhere we go, we see restaurants, we see retail, everybody's looking for help.
Yes.
Apparently there's a lot of unemployed people. Why not? Why haven't they returned to the market?
Well, there are lots of reasons, but as who's the guy, Carlisle, remember, who ran Bill Clinton's campaign in 1992? Remember that guy? And their campaign slogan was, "It's the economy, stupid."
Yep. So
it's the pandemic. Hello, you guys are still aware that there's a pandemic going on, right? So would you go back to a food service job during a pandemic? I'm sorry, I wouldn't. I finally went to a restaurant for the first time in a year and a half and sat down for a breakfast, a brunch, at Cheesecake Factory, by the way, in Waikiki, at the outdoor table in the corner of the terrace.
Okay, now you're just showing off.
Well, I'm just saying, not everybody's ready to go back to that kind of work environment. And not everybody's ready to go back to dining out in a group of people when you can pick up and get the same food. And by the way, even at Cheesecake Factory, things have changed. So you can be handed a menu that somebody else has touched and then supposedly decontaminated, or you can scan the QR code that they have at the front desk, and the menu pops up on your. So that should tell you about not just the supply of labor, whether people want to go back into those high contact occupations, which are unsafe during a pandemic, as well as the demand for that kind of labor. A restaurant where you can book your table to arrive, like you do a seat on an airplane, and arrive.
We hear employers everywhere saying, I can't get laborers, including restaurants, retail. So how are people surviving?
Well, that's what I'm saying. There's an app for that. There's an app for the menu. There's an app for the host
No, I
or
mean, the people
hostess.
who are unemployed, how are they paying rent? How are they buying food? How
Ah,
are they
well,
making car
that's
payment?
and by the way, we're only talking about one tiny segment. So there are some people who, because they're risk averse in the presence of a novel coronavirus, are disinclined to return to or enter occupations with a lot of customer contact. But there are also many people, predominantly women, who had a lot of trouble finding childcare, daycare last year as a consequence of the disruption imposed by the pandemic itself, and then secondary impacts like homeschooling, where everybody's lives, parents' lives were overturned or upended. And now this year, as students go back to school, such as it is when they're not sent home because of COVID in the school, there's still a shortage of childcare or after school care, partly because of the people who don't want to go back into those occupations. Then there's a whole nother set of issues regarding occupational safety. Are you getting compensated enough for, right? That a lot of people seem to have reached the decision that that job sucked before COVID and didn't pay enough, and I'm not going back to it. So for example, it's typical in the food service industry for people not to know their schedule 2 weeks out. And pre-COVID, maybe that was acceptable. Post-COVID, people are just saying, we could go on and on. There's another factor is the labor force.
But the answer, fast forwarding now, we've gone through a month. There hasn't been this big return that some thought there might. Well, other than the economist, so it's proven out just a bit no material rush back of these employees.
And let's be clear, it's not just a month. It's a month in Hawaii, but there are so-called red states, right? States where the administrations in those states early in the summer. So now we're talking, 4, 5, 6 months ago, made the decision that come June, let's say, they would reduce the unemployment insurance enhancements. So we've actually had the kind of experiment, the guys who just won the Nobel Prize in economics, these are the guys who helped us think about how we don't have the ability to conduct experiments on the economy, but every once in a while, things happen that lead us to recognize that it provides a natural experiment. And having, say, 15 or 20 states reduce their unemployment insurance benefit enhancements when the other 30 or 35 states have not, is a natural experiment. Did jobs increase sooner, more materially in the first batch of states? And the answer turns out to be no, when joined subsequently by the remainder of the country because of the expiration of the federal enhancement itself. Again, an experiment demonstrating that all these other factors, like the fact that for persons age 55 and over, the labor force participation rate has dropped by 3 percentage points. That is to say, 3% of the 3% of the persons, 3% of boomers who were working just said, take this job and shove it. That's it. They're out. And how big a cohort is that? Well, the boomers are at least as big as the millennials. So 3% of the guys, the most senior guys, people in occupations where they've built up human capital, a knowledge base from experience that hasn't yet been acquired or replicated by a younger age cohort, notwithstanding its similar dimensionality, can they, if they're all employed, or even if they're more likely to be employed, or for example, more likely to be working from remotely, right? If you look at the statistics on remote work, the age cohort that most actively has embraced telework is the boomer cohort. I'm sorry, the millennial cohort. And women have adopted remote work more than men in the same age cohort. So there's big changes in the workforce. And I think when you start lining them up, you realize the unemployment insurance enhancements, or for that matter, unemployment, the social safety net in general, was of an order smallness, leading us to shift the focus to these other influences and to recognize the pandemic has just permanently changed a lot of things. Among them is the nature of the workplace and people's willingness to engage in the workplace at all or on the terms previously considered normal.
Okay. Okay, good. All right. Well, let's shift gears now, and I'm going to try to pull this up, and I'm sure you've got some good info on this. This is the interest rate chart from Freddie Mac, and this is from this morning. And the interesting thing, when I went there, they have a big headline: mortgage rates rise above 3%. All right. This is the big headline. It's crazy to me we're still here, but we know why. But
it's crazy that's scary, but
exactly right. Below inflation. So what is your outlook prediction on interest rates, short term, medium term, long term?
Well, as I like to joke, as a recovering commercial bank economist, why don't you let me share my screen?
Yep.
Why ask Brewbaker for his interest rate forecast when you can get the interest rate forecast from Jay Powell and the Board of Governors of the Federal Reserve, along with the 12 Federal Reserve District Bank presidents?
The reason is they don't take my call. So I got to ask you.
Bro, they publish it. I'll send you this slide because the links in the footnote there in the source line will link you right to their spreadsheet. And this is, one aspect of monetary policy as it's conducted today, in addition to being able to move a target rate like the overnight interbank lending rate, the so-called Fed funds rate, in addition to that as a policy instrument, in addition to using their balance sheet, buying and selling securities, which we need to talk about in a second. In addition to those two instruments, they also now recognize their own communications as a monetary policy instrument. And so they, they give us forward guidance is what it's called. They provide to us, we the people, we in the financial markets and whatnot, forward guidance about their own expectations for interest rates and inflation, growth of the economy, so that their policy objectives, which are explicitly, they tell us, what their inflation objective is, 2%. They give us extensive indication of what their definition of maximum employment, which is the other objective they've been assigned by the Congress. The discussion we were just having about unemployment, for example, is a pertinent one, because they're looking at the same thing going, why is there such a low unemployment rate and so many job openings? It's never been like this in this country. And that means that there's something which it turns out monetary policy can't resolve, that things in the labor market and the structure of the workforce that is a legacy of the pandemic that we need to turn attention to, because the raising or lowering interest rates isn't going to fix those. But to your question about interest rates, here is the Fed's interest rate forecast for the overnight interbank lending rate, right? The Fed funds rate. And you've got to remember the overnight rate anchors what's called the term structure. So interest rates at longer maturities from 1 to 3 months, 6 months, 1 year, 2, 3, 5, 7, 10 years out to the 30-year Treasury bond yield. And ordinarily those yields are a little higher as you go out the yield curve. Although in a world in which there's lower inflation risk or no inflation risk, that is to say no risk that the inflation rate is likely to be significantly different from 2% over a long period. Right now it's 5%, so it can vary in the short run. In that kind of a world, you would expect long-term interest rates actually to be relatively close to short-term interest rates. And what we're seeing is that the Fed's expectation that its own target for the overnight rate, which right now is essentially 0, that its own target for that rate will creep up towards the end of next year or the early part of 2023, and then continue on the path shown in this chart to end up over, say, a 4 to 5 year period from now, going from 0 to something like 2.25%, or somewhere between 2% and 2.5%. And you see there's some disagreement about where we end up. That's the the blue area, the bandwidth around the central tendency of.
And Paul, so looking at this, if we're at 3 today, looking at their predictions, where do you think we'll be a year from now using their predictions, or 2 years?
So let's think about how the mortgage rate ties to the term structure. The average duration of a mortgage, it turns out, is about 7 years. And so the comparable interest rate on the yield curve would be something like the yield on the 7-year treasury note. Now, a mortgage has some risk associated with it, whereas the 7-year treasury note is theoretically, or an approximation to, the risk-free rate. And therefore the difference from, say, let's call it 100, let's say 1.25%, and the mortgage rate, which is, let's say 3%, that 1.75 percentage points difference is the risk premium between the risk-free rate of 1.25 and the 3% that an average mortgage would be booked at right now. So if the underlying risk-free rate is going to rise to a number like 2.25 to 2.25%, like the sort of the benchmark, plus the term premium, plus the difference you see there, about a percentage point between 0 and 0, percentage point and a half between 0, the overnight rate, and where the 10-year yield is right now, which is 1.5, then take that benchmark. What's 0 now will be, let's call it 2.25. We'll add, a percentage point to that. Let's say, I'm kind of making these numbers up. So now we're at 2.25. Now we're at 3.25, and then you add that 175, but maybe not all of it, right? Because there may be some compression of that slope because of the inflation risk-free world I described a second ago, where we really don't have fear about long-term inflation. There's just a short-term variation. And you could end up with a mortgage rate, that's up around, let's call it 4.5%, something in that. We could go essentially from the 3% or sub 3% where mortgage rates have been recently and are now, to something that's on the way to 5, but probably not in excess of 5%.
Which is still historically low. Yeah,
which is historically low for mortgage rates. If you want to let's put your graph back up and remember what that world looks like, because this is really important. People forget about the context, and the context of let's say a 4.5% mortgage is everything that's happened in the last 10 years, right? The 30-year, which is 3% now, let's say, which is that light blue line in your graphic, has, for the last 10 years, stayed somewhere between 4 and 5%. So what we're talking about is going back to that world, the world with the longest expansion in US history, the world where housing affordability on Oahu, measured by single-family home median prices, the average fixed rate mortgage rate, and based on median 4-person household income on Oahu, a world in which housing affordability was never better. Everybody seems to not know that these facts were true in the last decade. I don't understand why. I mean, I can show you the affordability math, but trust me, it was never better than it was for the last 10 years. All these people running around saying, ooh, we have a housing affordability crisis. Yeah, I mean, the crisis is we don't build enough homes. Not the same thing. You can't afford a home, that's a crisis. You can't buy a home because we don't allow homes to be built. That's a different crisis.
It's just real simple supply and demand. So speaking of that, we're going to take a quick break. But when we come back, I want to ask you, there's a little uptick of inventory and a slowdown of sales pace. And I'm wondering if this could be the sign of maybe something coming in the market turning. So stand by, we can take a quick break. Hold on one second.
Maybe the tiny bubble is over.
We're back with Paul Brewbaker, president of TZ Economics. And Paul, we're just about to talk about the housing statistics. It looks like a lot of the same to same, not too much action. But one thing we were talking about on the break is the inventory to sales pace. So I'm going to pull up the Honolulu Board of Realtors statistics here, and we've highlighted a few boxes. And my question, when I looked at the condo market, we see closed sales are down 8.9%. Active inventory has gone up 8.4. This is month over month. So this was last month compared to this month.
August to September, got it.
That's correct, right? So is that just a seasonal thing that's happening, or is it a sign that things are changing in the market? What's your take on that?
Yeah, that's always the problem, right? It's both to one extent or another. But generally speaking, seasonally, there tends to be a little bit of a drop off after the summer in terms of the intensity of the market, and so it's not unusual to see sales decline slightly from month to month, and it's not unusual as a consequence of that slowdown to see the inventory just pile up a little. I think another useful benchmark, given that that's a seasonal context, is taking out the seasonality by looking at September of this year compared to September of last year. And you've highlighted in the condo segment how months of active inventory in September 2020 were 4.5, whereas this year they've fallen to 1.8. So the excess inventory, the 4.5 months of supply a year ago, has shriveled to 1.8 months. It's been cut by more than half, almost a third, in the course of the last 12 months. And the same phenomenon has happened on the single family side, although in smaller dimensions, going from 1.7 to 1.2 months.
And Paul, when we talk about month supply of active inventories, that's total listings divided by the sales pace. And you and I have talked about this before. We generally think of equilibrium around 5 months of remaining inventory, something like that. Is that a fair statement to say, or and anything below that, and certainly we're in that moment now, is clearly a seller's market.
It's hard to benchmark in a different world, you know what I mean, from the one we used to live in. So definitely a year ago wasn't so long ago that we can't take away a message here, which is that the market is tighter, and has become tighter faster on the condo side. So there's been a catch up on the condo side to where the single family market already was a year ago. The single family market was tighter last year. Now the condo market's gotten a little tighter. 5 months to me seems a little high, as I say, in the world in which we now live, for a couple of reasons. I mean, we've got fintech, the title companies are way faster. Right, the process is faster. And so I'm thinking like the new normal is maybe 3 months. But let's not get too hung up on that. This is definitely a tight market. It's a tighter market than it was a year ago. In terms of the trend, as opposed to the seasonality, where we go from here is really crucial. And actually, let's look at those. Let's look at the prices as a different barometer, right? The sales and the inventory, or the inventory to sales ratio, which is what people in manufacturing look at, is a whole important separate set of indicators. But of course, this is an asset market, and asset prices are telling. And the story this summer has been that single family home prices on Oahu had breached $1 million, and condos had not. In fact, if you look at the stark contrast in these two market segment performances since COVID, it really suggests something beyond the trend, which I've actually drawn there. There's the trend for the 20 teens. It wasn't a roller coaster. It was an escalator. In fact, if anything, the escalator slowed down in 2018, 2019, which we now know was a period of economic stagnation for Hawaii, even more so, idiosyncratically. But this post-COVID explosion on the single-family side, which is largely absent on the condo side. I mean, condo prices have stayed sort of at the lower boundary of that trend, but they haven't gotten back to the trend in any meaningful way. That suggests that something very specific to single family homes has unfolded since COVID, a preference shift, so to speak. Now, that doesn't mean people are abandoning condos per se. I think there was some, there were challenging moments in the 6 or 7 months during which there was no tourism for anybody that owned a condo that was in the short-term rental pool. And many of those investors would have had an incentive to exit that market entirely if you're not getting any income for your asset. And that may have weighed on the market at a point immediately after the start of the COVID pandemic, through the resumption of safe travel protocols that enabled tourism to rebuild its volume over until the Delta wave this summer. So I think this chapter is near an end. In fact, if you look at the seasonally adjusted single family home price, what I show there, the September price is actually slightly less than the August price. Now, don't take too much from 1 month's change in values, but it raises the possibility that the bubbleliciousness on the single family side of the market might be petering out, that this preference shift towards detached dwellings or remote geographies. In fact, we could go back and look at one more slide and remind us that the markets that were appreciating the fastest last year in the single family segment were the more suburban and exurban markets, and the downtown area, the urban core, actually saw some downward pressure on single family home prices. We see this year to date, if you look at the 9 months of data, that push to the outer parts of the island has kind of come back, a little bit of a backwash is happening, which would be consistent with the interpretation of the preference shift as a one-time COVID-induced phenomenon. And going back to normal, as we see some of the backwash, suggesting that when relative values shift, right, the relative value between an urban condo and a suburban detached dwelling shifted in favor of the condo segment. And so for all the for all the boomer senior, workers who realize an opportunity to work from home, made possible by the pandemic, a format which now has been embraced by many employers as a more permanent situation, and so they pimped out a home office or whatever they did, moved to the suburbs. There are an equal number or even a larger proportion of millennials, people in the first-time home buying cohort, who are seeing a relative price adjustment that makes an urban condo even more compelling to that cohort. And they may be the ones moving back in and absorbing what had been an excess inventory a year ago. It's a process of rebalancing that I think we're right at the moment where we move into the next phase of this process.
In this month, we have several condos delivering in town. Azure, I think
new buildings,
buildings, brand new buildings. Ali'i and Ward Village, and the sales, the new sales at Ward Village continue to be extremely strong. It's selling out every single tower they come along. Okay, Paul, quick break. As soon as we come back, let's wrap up and talk just quickly about COVID and what you see happening out there. Okay.
Okay.
Okay, we'll be right back.
Okay.
Okay, and we're back with Paul Brewbaker, president of TZ Economics, one of Hawaii's leading economists. Paul, wanted to talk quickly about COVID, and we'll kind of wrap up with this. There was a New York Times article about a week ago, and I can't remember the name of it. Was like the COVID myth or something, but the article pointed out the last 6 months, schools have reopened. Sports are wide open on the U.S. mainland. 80,000, 100,000 people in a stand, no COVID protocol. all predictions would be that COVID case counts would have just gone through the roof and we would have been spiking. The article said that, in fact, COVID case counts across the country have actually been declining. What do you make of that, and what do you think?
Well, as they say with automobiles, your mileage may vary, because Hawaii just had its worst COVID experience ever, like a month ago. A month ago, Hawaii's COVID incidence was the same as Arkansas. So yes, it's declining now, but it's declining from the fourth wave of COVID. And it's had an impact. For example, in tourism, these are the daily passenger counts this summer versus a couple of years ago, pre-COVID, versus 2019. And the green shaded area in the back is the COVID case count, daily COVID case count in Hawaii, which peaked around Labor Day. And you can see the decline in travel, part of which is seasonal, from July to August, September. In a normal year like 2019, the daily passenger counts tend to settle. These are data through October 1st. If you subtract 2019 from this year's volume, so that the negative change, the difference, the decrease you see between July 21st and August 23rd is a COVID event, right? It's not the seasonal change. It's the pandemic, right? It's the effect of the rising Delta variant case count in Hawaii, discouraging people, and case counts elsewhere, like Alabama and Florida and elsewhere, discouraging people from traveling. And in the end, it caused about a 40% reduction in travel, of which maybe 25 percentage points, maybe 10 to 15 percentage points are seasonal, and another 25 percentage points are attributable to the pandemic. So it's not over yet. We see this in other behavior. These are cell phone mobility data that Google publishes for Hawaii. So you can look at where Hawaii, how long people spend in grocery and pharmacy stores or in other retail and recreation locations. And that cycle you see is one in which people spend more time when when a COVID wave, and there have been 4 of them, they spend more time at the grocery store when COVID is abating, and less time it turns downward when COVID is ascendant or reascendant. And we just had, as I say, our worst wave ever, and it's now over. So in that sense, the article in the New York Times is correct that for now it's better. More people are vaccinated than ever, and I'd also point out that we may never spend as much time in grocery and pharmacy stores and other retail locations as we did pre-COVID, because one of the things COVID has taught us is how much easier and more convenient it is to engage in e-commerce. There's a whole nother link to the conversation we had earlier about how many people don't seem to be working anymore. If you look at the number of applications for a federal employee ID number, post-COVID, they've exploded. They're 3 or 4 times as high. People are forming enterprises more actively than ever before. And I think part of it is they've discovered they can do it on the internet, that we conducted simultaneously this mass experiment in doing everything differently for a period of several months in 2020. A majority of US gross domestic product was being produced at home, not at workplaces. So we're not going back to the old world. And for a lot of people, they're like, hell yeah, I'm gonna do this new thing,
Right.
because I make more money. I don't have to. So we'll see. COVID, we're going from a pandemic to an endemic presence of the novel coronavirus, one in which it will continue to evolve. The vaccination opportunity will have to evolve with it, just as it does for your flu shot. We get, those who are in vulnerable categories get a new flu shot every fall, because you can sort of look at what happened with the flu in the winter in the other hemisphere. And as you think about our winter, the nature of the evolution of the virus that will be present 6 months from now, and you adapt the vaccine accordingly.
Right.
That's the world
And
we're
we're heading into the winter months, which traditionally we'd see upticks, both influenza and theoretically
That would be the
COVID
message I
outbreaks
would
as well.
leave for everybody from that first slide we were just looking at. The fourth wave is probably not going to be the last wave. I mean, knock on wood, it should be the least intensive wave we've ever had. Let's go back and remind ourselves what's going on. Hawaii got lucky in the first wave, which is way over here in March. Remember how scared we were in the first wave? We locked down the entire economy. We got lucky in the summer wave. We had a small version of what happened after the motorcycle rally in Sturgis, South Dakota. We avoided the winter wave. Look at what was going on in Arkansas and Florida back in the winter, but we got snagged in the fourth wave because we thought we're all vaccinated. We thought we could go party. We didn't have to wear our masks outdoor anymore. We're going out to eat. You know, when you let down your guard, the evolved form of the coronavirus, just like Pokemon, is going to take advantage of the vulnerability. And I'm not predicting a fifth wave. I'm saying the way you should run your business is by contemplating it as a risk factor, right? The downside risk is a fifth wave this winter in conjunction with influenza, as you say, which we avoided last year because we were all masked up. And how would you conduct your business? How would you keep the business going? How would you keep it thriving if another wave came along and you couldn't get people into an open house and the whole 9 yards? And a lot of people have just gone virtual permanently.
Well,
So
hopefully,
that may be the way.
hopefully the vaccination numbers continue to climb, and
with any luck.
With any luck. So, Paul, it's always a pleasure. Really, really enjoy the time with you. For people watching, if you enjoyed this, please consider giving us a thumbs up down below. And we will see everybody next week. And before we go, Paul, just wanted to let you know.
Next week or next month? You do this every week?
No, next month.
Hey, nice hat.
Yeah.
But you don't need a haircut. You're so meticulously groomed every one of these times. I'm the one who's a long hair right now.
That's good. Well, go Bows, and we'll see what happens this weekend. So, Paul, have a great weekend, and we'll catch up soon.
Mahalo, Patrick.
Thanks.
Aloha.